We got a podcast coming out today at noon, and this is one we've been working on here for a couple of weeks. Grant Williams, who's the co-founder of realvision.com, author of the things that make you go, financial blog, and he's a very good writer and a very smart guy. We recently interviewed his partner, Raoul Pal, who was a hedge fund manager, live from the Cayman Islands. What a life that guy has, right? He sits around in a T-shirt all day, managing money.
When we connected for that interview on Skype and I saw what he was wearing, I'm thinking, we're videotaping this, right?
Right, yeah. He doesn't care. But, he's retired. He's like 38, retired. He's
got this wife beater on.
Right. So he's just hanging out, living on an island. I mean, how bad can it be, right? So, but
poor guy.
Yeah, we're interviewing his partner. He actually wore a button-down shirt, so he's actually in much better shape. Grant Williams, though, like I said, it was a really good interview. We talked a lot about kind of where we are within, kind of the current economy, current cycle, and by ways of perspective. Talking about the bond market in particular, we talked, there's been a lot of talk, a lot of headlines lately about negative interest rates, right? Got negative interest rates all over the world, $17 trillion. In fact, when I was interviewing Grant, I said, we've got $13 trillion in debt. He says, well, apparently you've slept since last night. We're at the 15. Well, a week later, we're now at 17. This is how fast these negative yields are rising. And again, they make up almost, they're quickly approaching half of the total world sovereign debt. So you think about all the U.S. treasuries, all the French treasuries, Russia, China, everybody's sovereign debt. We're approaching half of that carrying negative rates. So we were talking about this though, and again, the issue is not just with sovereign debt. Our government bonds, our U.S. Treasury, which is the bonds that we issue to pay for our excess spending. But it's also the issue with, corporate debt as well. Back during the financial crisis blew up on $600 billion worth of subprime home mortgages. Well, now we're talking about $1.5 trillion of corporate subprime debt that's sitting out there. It's called covenant light loans. And, these are out there and really have the potential for causing a lot of damage in the markets, particularly as we start to see oil and gas companies, smaller oil and gas players that have benefited from low interest rates. They've been surviving on debt, just, cheap debt to fund operations, et cetera. And that's where a lot of these leveraged loans, these covenant light loans exist, is in with weak marginal players that have been using low rates to exist over the course of the last couple of years. Anyway, we talked a little bit about this. Grant Williams, this is what he said.
It says a lot about the investment environment we find ourselves in. The only game in town has been front-running bond purchases of central banks now. But I think more than that, more than the capital appreciation people are buying bonds for, which in the world you and I grew up in is not exactly what they're for, this talks volumes about the fear levels that are out there, the things that people are frightened about, chief amongst which is a recession. And obviously, with this amount of negative yielding debt, a slowing economy and an outright recession would be catastrophic.
Again, this kind of goes back to the same premise that, occurred during 2008, right? So, everything was fine. In 2007, everything's fine. We've got a housing market, Goldilocks economy. The economy's slowing down a little bit, but nothing really to worry about. The Fed is, hiking interest rates and everything's okay. Early 2008, were subprime issues time to start to pop their head up here a little bit. Bear Stearns goes bankrupt as their a couple of their big mutual funds kind of go belly up over subprime mortgages. But again, Ben Bernanke, then Fed chairman, comes out. Everything's contained. Don't worry about it. Subprime's contained. And of course, we were warning about the issues, just as we're warning now about the issues with covenant light and leveraged loans. We were warning then about subprime mortgages. And, those wound up being the catalyst kind of, for the end of the markets. And so now when we're talking about this, kind of this decade of central banks now having our backs, doing all this type of, bond repurchases and quantitative easing and these ultra low interest rates have led to these kind of dicey deals being made. And as I said a second ago, one of the big sector concerns right now is in the energy sector, which is what is a big driver of the Houston economy.
We used to talk about the central bank put, but now we're all on the same side of the central banks. They're buying bonds, we're buying bonds, and we figure that, well, they're not going to do anything that hurts themselves. And so they're going to keep buying the bonds. We're very, very safe standing in line with them and buying the same instruments. But this is the big problem. We're starting to see the defaults, and that's with the Fed having raised a fraction in terms of the federal funds rate. This is why they're starting to fear that they've gone too tight, which they can keep rates low, and these guys can keep refinancing their debt at these crazy low levels. This rolling default happens all at once, and many of these companies, a number of zombie companies out there, the number of companies that can't service their debt from their cash flow is extraordinary. And so unless rates are kept at these unfeasibly and artificially low levels, the whole system is going to start freezing up. And when these defaults start happening across the oil patch, it's going to be a rolling cascade.
We're already starting to see some of those defaults begin. And they're very small companies, very marginal drillers that were drilling unproductive wells using debt to get there. We're seeing that. We're seeing those. Those are always kind of the first guys to go. And you are starting to see that. So pay attention to this, because this is very important, not just for the state of Texas, but also for the Houston economy as well, because what happens with the oil patch is a lot of what happens with our Houston economy. But shifting gears here a little bit, we also, talked about the issue of, the markets themselves and kind of, alternative investments and the issue of, gold and how that kind of plays into the issue of where we are in the markets now. And again, we've seen a big spike in gold lately as fear has kind of started to impact the markets, the concerns over what the Federal Reserve is doing, the rise of the trade war between Trump and China. This has all led to fear in the markets, and we've seen kind of a flight to safety between both bonds as well as, because yields have been dropping to very sharp lows. Bond prices have gone straight up here as of late. Gold prices have had a very sharp rise. So let's see what Grant says about gold.
Gold is sniffing out the potential problems that we're seeing in the bond market, that we're seeing in the economies. And so for me, it's another conversation that has been going on for a long time. People who've been talking about it, trying to make people understand just what gold is and how they should think about it, have been given that delightful term, gold bugs. But it's another asset that has a time and a place in a portfolio. And my personal belief is that time and place is now. It's certainly the time to understand it and decide whether it's something that you need in your portfolio. For me, I think it's time to have a serious allocation to gold.
What Grant was, kind of believes here is that it's kind of incumbent on everyone to, be that's invested in the markets. And a lot of us have investments, either directly or indirectly. We have a 401k plan, or we've got an investment account, or we've got an IRA, or we've got a SEP IRA, but we've got money invested at risk. And for a lot of us, it kind of sits off to the side. We really don't pay much attention to it. Our 401k plan just kind of automatically deducts money, throws it to an account, and there's an allocation there. Maybe you have a target date fund, whatever it goes into, but you really don't pay a whole lot of attention to it. You're busy kind of with life, right? Raising kids and taking care of your family. When we don't pay a lot of attention to these things, but we will pay attention to it when something comes along that really takes away a lot of that value. As long as the statement that you get is going up, it's fine, right? You may not even open the statement when it comes. You just kind of throw it in a drawer. But this is why it's kind of incumbent on us, because you've worked hard for that money, and you've got that invested, you've got that risk there, and this is why it's kind of incumbent, if you're invested in the market, to at least have a basic understanding of kind of what these macroeconomic environments are doing and what they're trying to tell you about money that you've got at risk.
We have currency wars, we have trade wars, we have negative yielding bonds, we have central banks chopping and changing, we have a race to the bottom, and that makes a massive difference to this kind of easy investing environment we've had for the best part of a decade now. So I would just implore everybody to do a little reading, find people who they feel have a handle on what's going on, and just understand their thoughts. If they're contrary to your own, even better. Find people that disagree with you, understand their point of view, and then decide whether you think they're full of it. And you might decide they are. That's fine. But so many people don't bother to challenge. They don't bother to try and understand the macro environment. They think the environment we've had for the last 10 years is going to go on forever. It's not. I would argue that it's finished already, and we are at a major inflection point. And the more reading you can do, the more you can understand what's going on.
Of course, we've talked about the problem with, our Facebook pages, our Twitter feeds, our LinkedIn pages, that we all get kind of in these echo chambers of everybody that agrees with us. So we only get kind of one side of the story, whether it's political news or whether it's financial news or whatever it is. We only kind of get one aspect of the story. And so he's very right about this, is that it's so incredibly important to watch and to read views and opinions that don't agree with you. So, and that helps you be better prepared and better informed about the decisions that you make. And particularly when it comes to your family, your work, your money, those type of things, challenge yourself a bit to, expand your horizons, look at different views of opinion, and balance those things off. And whatever you decide you agree with, that's fine. But at least you've got an informed opinion about doing it. So, quick break. We'll be back. Got some other stories to get into this morning. Don't go away. You're listening to Lance Roberts Show right here at realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.